This past Saturday, billionaires Warren Buffett and Charlie Munger spoke at the annual shareholder meeting of the Berkshire Hathaway holding company they lead. One of the main events in the world of finance and investment began with a video of Munger, a Berkshire Hathaway vice president, unsuccessfully trying to open a box of seized Candies peanuts. When the video ended, both billionaires took the stage and appeared before a crowd of 20,000 people seated at the CenturyLink Center in Omaha, Nebraska. At a table where Berkshire Hathaway executives were seated, 94-year-old Munger had a box of candied peanuts waiting. "My name is Eddie, and I help educate people about money, personal finance, and investing. If you are interested in improving your financial future, be sure to subscribe to the channel and click like if this video was helpful." That year, with World War II in full swing, the legendary investor made his first investment, buying a few shares of the city's service oil and gas company. The stock soon began to plummet, and before it resumed rising, the company's capitalization had dropped by a third. Buffett is now more aware than anyone of stock market volatility, but at the time he sold City Service shares, making a small profit. The story, of course, was cited to illustrate Buffett's main investment principle, the so-called compounding, or the ability to understand how much capital will be worth in the future. If in 1942 Buffett had invested the $114 he had spent on City's service stocks in the S&P 500 index and done nothing else, today he would be the owner of a fortune of $400,000. And if someone, Buffett appealed to his audience, had invested $10,000 in the S&P index at the height of World War II, he would have $51 million today. Berkshire shareholder meetings are often the source of statements affecting stock markets around the world. Such as a few years ago, when Buffett explained why he fell in love with airlines and became a major shareholder in companies like United, Delta, American, and Southwest. That speech of his still has a magical bullish effect on the airline industry. So investors always expect meetings with Buffett to tell them how Berkshire will dispose of some of the $100 billion under management. But this time, the Oracle of Omaha was silent about the big acquisitions. And neither have the sales. The scandal surrounding Wells Fargo Bank, of which Berkshire is a major shareholder, has been frequently covered in the press of late. In 2016, it emerged that bank employees were carrying out a plan by opening accounts to customers without their knowledge, but Buffett unexpectedly expressed support for Wells Fargo CEO Tim Sloan. "I like this investment," Buffett said of Wells at a shareholders meeting. "I like Tim Sloan as a manager. He corrects mistakes made by other people." The upshot? Don't expect Berkshire to sell its stake in Wells. What else was talked about at the meeting? Duracell, the company Berkshire bought from Procter & Gamble in 2014 for nearly $4.7 billion, has not succeeded. A strategy is now underway to grow its revenues. Buffett also rejected speculation that Berkshire, effectively sitting on a mountain of money, would pay anything to its investors. The company pays no dividends. He is convinced that if there is a vote, shareholders will support Berkshire's existing strategy of investing excess funds and historically generating high returns. Meanwhile, Apple, in which Berkshire acquired a stake not long ago, is to be commended, in Buffett's view, for its management's willingness to give money back to investors by buying back shares. But Buffett does not intend to use such generous gestures in Berkshire's practice. Still, the meeting may be an occasion to rethink the simple principles of investing and common sense that have made the tandem of Buffett and Munger so successful. One of the wise thoughts expressed by Munger was, "Part of the mystery of Berkshire is that when you can't do anything, Warren is very good at doing nothing." Or Buffett's analysis of what went wrong with Stagecoach, another name for Wells Fargo Bank, whose symbol is a horse-drawn carriage. Wells Fargo is a company that proves that incentives are effective in business. They just had the wrong incentives. But let's remember the story with which Buffett began the meeting about investing in 1942. Basically, you should have made one investment decision in your life, Buffett said confidently. The most obvious and surest path to prosperity is to patiently build up your savings along with the growing productivity of American business. We've been operating in this country with the strongest tailwinds, Buffett said. And about investing, you can't really fail unless you buy the wrong stocks, try to regulate the market, or are tempted by some high commission product sold to you on Wall Street. Buffett and Munger consider themselves teachers. Year after year, they give the same basic advice. Now might be a good time to pay attention to it. The market has long been a cause for concern, and especially now that it is near historic highs. The economy has been recovering for nearly a decade, unemployment is below 4%, and the Fed is raising rates to cool down the market. In this environment, the voices of those who advocate selling off stocks before they correct are growing louder, on the premise that market regulation doesn't really work. Moreover, despite Buffett's impeccable arguments about stocks in the long run, young investors are attracted to new ideas, such as cryptocurrencies, which are all the rage on college campuses. So much so that the question about cryptocurrencies was even asked at a Berkshire shareholder meeting. Is it a good investment? Here's how Reuters relays Buffett and Munger's answer: these are intangible assets. Basically, they're not going to bring anything but scarcity. What do they produce? Every time you buy an intangible asset, you expect someone to buy it back from you later. It all ends badly. Cryptocurrencies will end badly. At the Forbes Centennial celebration in October, Buffett made a bold prediction for the next 100 years. The Dow Jones will break the 1 million point mark, now 24,500. This is a bold statement, but it is based on conservative assumptions. The Dow needs to grow about 4% a year to reach a million, less than half the average annual gain over the last 100 years. Berkshire shareholders certainly know this. If Berkshire's A shares at 10% a year, in 2218 one paper will be worth $4 billion. Thanks to everyone who was here. Watching my videos, you become financially literate and get closer to wealth. Subscribe to the channel, share with your family and friends. Success to all, and have a good investment.